Howdy, Jacob here. Today we're looking at Danaos Corporation in the marine transportation industry. Initial valuation prices look very interesting with a 0.5 price to book and a 2.4 price to earnings. 1.4 billion market cap, essentially the same enterprise value. Looks like they provide container and dry bulk vessel services in Australia and a little bit of globally. Growth has not been very substantial, but 2021 and 2022 saw historical levels of growth compared to history, where it was actually going down from 2014 to 2019. And the earnings are very volatile, with negative 47 earnings per share here, negative 3, but then as high as 51 and currently 29. Dividend per share just recently, due to the fact that they're producing a very substantial amount of earnings and paying a little bit in dividends, and then the last 3 years at least, huge returns on invested capital, again due to the fact that their earnings have been so high. Balance sheet shows $272 million cash on hand, $86 million in short-term investments, so we're looking at about $368 there or $358 there, in relation to $383 million long-term debt, $21 million short-term debt. So cash and cash-like products can essentially pay off all of your debt, leaving maybe $50 million left over, and they produce a huge amount in free cash flow, well above that. So their balance sheet perspective, not worried about it. Looks like their use of cash is a little bit on the acquisition side, a little bit of share repurchases. Dividend isn't very substantial, and they've just been paying down a lot of debt here. So, they do have debt still to pay down. This is very impressive. They went from $1.5 billion in debt in 2018 down to $383 million 5 years later. So they've definitely been very good at deleveraging their business, which we can see makes their price to book a 0.5, which is very impressive. But still, you have to think that what I view the balance sheet as is, if the business were to go under, what are some of the things that they can sell, and what's the price that they can get for it. So if you can actually sell all the property, plant, and equipment that they have for $3 billion, even if it's 80 cents on the dollar, and you're looking at essentially $2.5 billion, then you have $3 billion here minus the $600 million in liabilities. You're looking at 1.9, which is well above the market cap. So if you think about the business in respect to all the assets they have on hand, and if you're able to calculate truly what you think these property plant is worth, these long-term assets are worth, then this could be just a good play in the fact that it's very safe. I think that there are certain situations where the balance sheet can create the worth of the business, but in a lot of aspects, it is the free cash flow. And so that's why majority, probably 99 times out of 100, I value companies on their free cash flow basis. But there are certain instances to where looking on a price to book can make sense. More so, I look at it more as like a net. So I look at like the total current assets valued certain ways being greater than total liabilities. But this can still be a safe investment when you look at what this property plant is worth, and seeing whether we think it's actually worth $3 billion or close to it. Because even $2 billion, you're looking at $2.5 billion in relation to that, $1.4 billion, and that's the total market cap. So really, I view the balance sheet as safe or not safe, and then kind of tweak the margin that I look for from that. Not necessarily evaluating from that, but you absolutely can. That is a form of evaluation, just not the one that I commonly use. So I think I'm ready to start making some assumptions here. I'm skeptical on this revenue growth due to the fact that they have jumped up very substantially here. And there was one acquisition, but or one larger net acquisition, but really nothing that should spur doubling in growth over 2 years. So I feel like we'll probably get down to very little growth here. And then due to it being a light growth business, I'm just skeptical of putting a PE, price free cash flow, at the end of 7 years beyond what you'd get for a no growth business. And then on the cash flow side, they have been producing very substantial cash flow, but I've been paying debt for it. So I don't I'm going to be using a lot of estimation and what exactly I think their use of cash flow is going to be. And the margin side, I mean, you're looking at huge margins. Let's say maybe 40 and 30. Let's do 35, 25. I feel like I'm fairly comfortable with those. And then share change, they've bought back, let's see, 70 million over here. 2% would be just 27, 28 million. Offsetting stock-based compensation, 40 million. So all I did there was what's 1% of their market cap currently? It's about 14 million. Times it by 2, 28 million. You add on the stock-based compensation to offset the increase in shares from issuing shares due to stock-based compensation. And you're looking at roughly 40 million, which, I mean, they can definitely afford that. But historically, they haven't done more than that. So I'm not going to put, just because they have 1 year at 71 million, I'm not going to say, oh, it's definitely buying back 4% of shares. I have to balance out what I think they're going to do with what I want them to do. And I definitely want them to be buying back shares, but historically they haven't been buying back, a bunch of shares. And I should clarify, I want them to be buying back cheap shares. If the shares are not cheap, then it's a poor return on investment, and I'd rather them do something else that is the maximum return on that investment. But outside of that, the dividend, 60 million, I mean, they can afford that. How much so? Pretty easily afford that. So let's increase that. I mean, we just don't have a long history, so I'll keep that the same. And I mean, I think the two things that I'm wondering whether I'm accurate on are the margins and then the terminal P and price to free cash flow. I'd be interested to see what their historical PE is, and I'll actually do that right now because I don't want to do a deeper dive if it's historically been extraordinarily small. And I guess we've seen that. I mean, since 2017, you're looking at a sub 4P, and over here is likely due to the fact they just have volatile earnings. And that's on a free cash flow basis, a bit more consistent, and it's consistently extraordinarily low. So this is the type of business that I kind of just question, why is this the case? And it might be to a point where I'm like, I just don't understand why a price to free cash flow would be less than 1. It just doesn't make sense to me. Because the only reason I would think that a P price free cash flow would be that low is either you don't agree with the numbers or it's a one-time phenomenon. But this is consistent over a 6-year period where their P and price free cash flow are less than 4. So, I mean, if I put that there, it works in relation to history, but it's not something that I totally comprehend. And so this might just be a business that, I just don't necessarily understand, because I think a no-growth business should be worth 10 on the P and price free cash flow due to the fact that if you look at a terminal, that's the formula of a terminal growth rate given a discount rate of 10%, which is historically roughly what the market makes. You should have a 10P. And even if it's negative, you could put in a 7 or 8 and it would make sense. But 3 on the PE side for a business that I think still possibly has growth ahead of them and has huge years of earnings ahead of them. I mean, it just doesn't make a whole lot of sense to me. So my final valuation gets to here, but again, it's just I question my understanding of the business in whole. Like, why would business be selling for this? And historically, if it's been doing that for very long, it's just something that I'm going to be like, I just don't understand it, and I won't get into it. So I just wanted to say that you don't have to understand every single business. I mean, Mohnish Pabrai's first thing that he brings up is always circle of competence, and I think that, to me, numbers are something that I grasp very well as an actuary and risk management. I'm very risk averse, but when it comes to just not understanding something, I think that it's good to know your boundaries, and I think that I'm a little bit skeptical of totally understanding this business and how it sells for so cheap. But hopefully, you learn something and have a great experience. Maybe.